Welcome, everybody. Good afternoon. Time to get to know Schwab.com a little bit better here. Today, bonds. How relevant are they in your portfolio? And how do you actually research them and trade them on Schwab.com? That's what we're going to be doing next. Glad you're joining me here for the ride, but I'm also glad to be joined alongside Mr. James Boyd, who's helping me out in the chat. So as you have questions, feel free to type those in the chat. Between James and myself, we'll do our best to help you out on that. Also, feel free to follow us on X, at Brent Moore CS, at James Boyd CS. And remember, as we get into this today, the information is for general informational purposes only. Should not be considered an individual recommendation or endorsement of any security, strategy, or chart pattern. And just remember, all investing involves risk, including risk of loss. Fixed income securities are subject to increased loss of principal during periods of rising interest rates. Fixed income investments are subject to various other risks, including changes in credit quality, market valuations, liquidity, prepayments, early redemption, corporate events, tax ramifications, and other factors. Okay, so there's our disclosures. Glad to see some familiar names there in the chat. And those of you watching and recording, we're glad to have you here as well. So to start us off, let's head on over to the Schwab.com website and talk about bonds. Why do people trade bonds in the first place, I guess, is the question. You guys have all heard of bonds, I'm sure of that. But a lot of you probably are going, where do they actually fit in this portfolio? Because if you listen, to be honest about most of the classes that James teaches and most of the classes I teach or any other coach, we do focus on equities or maybe options. We do some options, but we don't talk about bonds a whole lot. People typically will invest in bonds for income purposes. They'll do it for more capital preservation purposes. And they'll also invest for diversification purposes. There's quite a bit of info on this website. On bonds. So I want to kind of show you where some of the is. And a great place to start, I think, is in the Learn page. So we're on Schwab.com. Go to Learn. And if you click on Courses, and it should come up with courses. Sometimes just little tip here. Sometimes when I click on courses, it doesn't go to courses, and I just got to click again, and the second time it has always worked for me there. Okay, so there is actually a fixed income, an income investing course that actually has a third of it maybe has to do with bond investing. So you may be of interest to you there on that. But let me just show you a different one. We have simple steps for a retirement portfolio. And I'm going to click on that. And this is a course you can go through. And there's a few pages here, a couple pages I want to show you. You know, one reason why people invest in bonds is this. I'm just going to go to this building a portfolio section. I'm going to click on the bonds area on this. And here's a graph. And this graph isn't the ideal graph, I don't think, because it's hard to tell. But how many of you were around during the tech bubble time period-ish, around the year 2000? Okay. How many of you were around the financial crisis time period there? I remember both of those pretty well. This chart also has market crash of 74, 75. I was a little kid, so I don't remember that. But one thing I want to show you, the green line is large cap stocks on this graph. And you know, you can see what happened to large cap stocks here during that time period. And the reason I say I don't love this graph so much is that it doesn't really tell you the full dynamic of it, because that is actually a big drop that occurred in equities during that time. Financial crisis, 2007, 2008. This was a very large drop that occurred during that time period. Any of you who lived through that probably can attest to that. I remember those very well. Those are very big drops. Well, what happened to bonds during that time? Well, bonds actually held up, that's the yellow line right here, bonds, okay? The yellow line. You can see what bonds did during this time. It doesn't mean that every time the market drops, bonds are going to do well, but just looking back historically, which is basically all I can do because I can't predict the future necessarily, but if bonds, if this can help moderate a portfolio. So very often with a portfolio, we talk about returns and we talk about risk. This can help bring down the risk of a portfolio. But I would be negligent to not tell you, hey, look, long-term performance, stocks have outperformed bonds. And therefore, a lot of traders will put a portfolio with bonds and stocks in it, though. Okay, so let's take a look at this. Let me go here. And by the way, this is not a recommendation for any of you of what you should invest in here, whether you should invest in bonds or not. But I just want to point out to you kind of common approaches. Okay, maybe it doesn't fit you exactly. Common approaches. This is again in that simple stocks for a retirement portfolio course. It's going to take you through this. I would suggest you go through the course. Here's kind of in a more aggressive allocation. Notice it has a certain, like a pie chart there. And you can go through and moderately aggressive allocation. And a lot of this depends on how far you are away from like a retirement or an investing goal. And you can see bond allocations kind of creep in the more conservative you are in your portfolio, and conservative portfolios may have more. So there's that. Okay, that's the first thing. Now you may hear somebody talk about like a 60-40 or an 80-20 or something like that, and they'll say, does a 60-40 portfolio apply? What are they talking about there? What they're talking about is like 60% in equities and 40% in bonds. And I think that is far too simplistic an approach for most of you. But my goal here isn't to give you a specific cookie cutter approach. My goal here is to get you thinking about bonds and some of the pros and cons here. All right? So let's do it, okay? So that's the first thing I wanted to tell you is where to go for bond information in terms of the education aspect on this website. We'll go to actually, we're looking for bonds here in just a little bit. But let's talk about something. Let's talk about what are bonds. Because we talk about bonds, hey, but do we invest in bonds or not? It's just like this magic entity that goes up or down. Bonds are actually just loans that you're giving to the federal government, maybe a local government, maybe you're giving loans to a corporation. That's what a bond is just a loan. And in fact, we kind of often will break down bonds into corporate bonds. I'll just do some abbreviation here. Treasury bond, corporate bonds are obviously loans to corporations, treasuries, loans to the federal government, or munis. And I'm not going to talk as much about munis today, but loans to like municipalities is kind of a common way to think of it. Maybe they're building a bridge, a toll road, or something like that. That's obviously one way, or they need to raise money for education or something like that. So there's different types of bonds. You can see this, by the way, on the Schwab.com website. So let's go back to that Schwab.com website and come up here, and I'm going to go up to research, and I'm going to click, guess where? Bonds, CDs, and fixed income. So here's bonds, CDs, fixed income. You can see fixed income offerings, and here it's broken down. Treasuries, corporates, municipals, okay? There's the three main types that I discussed with you a minute ago. So, and one thing I want you to notice is this. Let's just pick treasuries here to start. So this would be loans to the US government. Here is the interest rate for whatever term you are looking at. Let me scroll down just a little bit. So here you can see how long it is, okay? And you can see the interest rate. Now, the interest rate sometimes can vary very significantly depending on how far you go out. What you're going to notice right now on the ones I'm underlining is it really isn't a huge difference here on that. And that's because what we'd say is we have kind of a flat yield curve. And you can actually see that below on this page here. If I go down here, I think, yeah, down here, you can see the yield curve. And this is kind of maybe a compressed yield curve, but you can see this is pretty much a flat line that we're talking about here. But if a normal yield curve, often you get a little steeper, kind of looks more like that is what a normal yield curve may look like. That's what we call a positive or normal yield curve. We have actually, in the not very recent past, had an inverted yield curve where it kind of went like this more. Okay, that's an inverted, and that's usually not a sign of economic health. But that is that's the yield curve. But right now, you're not seeing a huge difference, are you, between the different maturities here on these? Okay, and that's true whether you're looking at treasuries, corporates, or munis. Now, one thing that you may notice is it gives you different rates, though. If I'm looking at a treasury bond, we'll say 1 year, and I'm comparing that to a municipal bond, the municipal bond typically has a much lower rate, and that is because there can be tax advantages to investing in municipal bonds. All right, that's about it I'm going to go into on municipals today, though. So you need to consult your tax advisor on that. I'm not allowed to talk about taxes, and I can't really get much into municipal bonds either, but just realize those are a category there for you. But as you go out in terms of duration on these, what you're going to see is you can see different interest rates, okay? But also, bonds are graded. And one of the risks of bonds is, like especially with corporate bonds, but I guess technically with government bonds, is the risk of default. And so if you loan money to your buddy, there's a chance your buddy is not going to you can see how good a buddy your buddy is, I guess, but there's a chance you may not get repaid on that. That's a default, okay? You can loan money to a corporation, and there's a chance that corporations go out of business, right? That happens. Companies go out of business, and you may not get repaid. Now, in the chat, James helping me out in the chat, so I do appreciate James helping me out in the chat. And James mentioned, yeah, bond investors, let's say you go to a bankruptcy, bond investors are going to come before corporate investors, before stock investors, equity investors, but you still may not get your bond back. You still may not get repaid. So that's why bonds are graded. AAA, AA, A. Okay, so as you go down the spectrum, and these would all be investment grade bonds here, these become more risky. In other words, there's ratings agencies out there, S&P, Standard & Poor's, or like Moody's, that will rate companies on their credit worthiness. Okay? The governments get rated on their credit worthiness too. Okay? And so if you go to something that is a lower rated bond, then you're probably going to get a little bit of better interest rate. So you can compare the rate on an A versus a AAA. You probably have a greater chance of being repaid properly with the AAA than an A, and therefore the company doesn't have to pay you as much. Okay? The company doesn't have to pay you as much. Now, you can go down, there's B bonds. We don't list them here, but you can go to B, double B, B, you can go C bonds, C plus, whatever. But at a certain point, you get down to what we'd call high yield bonds, or also known as junk bonds. And they typically pay a much higher rate, right? Because they're lower quality bonds. There's a greater chance for default. And so the company has to pay a higher interest rate, a higher coupon, in order to attract someone to loan them money. All right. So that's how you can kind of look at this chart here. Okay, so now that we've talked about duration, there's differences in durations and there differences in type of bonds, and that is going to largely affect what the coupon rate is on those bonds, how much you get paid. And bond payments usually semi-annually, in other words, twice a year. Okay, twice a year. Now, there's another thing I want to mention here. When you buy a bond, it's kind of like a teeter-totter or a seesaw. When I was a kid and I went to a playground, there were these teeter-totters, right? And it was a little game, and one person would get on one end, and there's one person, and then somebody would be on the other end. Again, sitting down. I'm not a very good artist here, so they're sitting down, and you can go kind of rock back and forth. And when one person went up, the other person went down. Now, you don't really see those, at least in the US, in playgrounds much anymore. I never see them these days. I think for liability reasons, probably. I don't know. But this is what you get when you talk about bonds in terms of the price of the bond versus the yield or the interest rate on that bond, okay? And so when interest rates go up, prices go down, okay? When interest rates go up, prices go down, and vice versa. When prices go up, interest rates go down. So one of the disclosures at the beginning of the session today, I read, I don't remember the exact verbiage, but it was something to the effect of bonds, a rising interest rate environment can harm your bond prices. That definitely was not the exact wording on that, but something to that effect. Remember, this inverse relationship between prices and yields. So if you buy a bond, let's say you buy a corporate bond, and you want to sell it at some point later. Okay, there's a secondary market on bonds, just like there is stocks. You buy a bond and you want to sell it later, and the interest rates go, say, we'll say interest rates go down. What's going to happen to the price of that bond? The price of the bond is actually, you're probably going to get a better price on that bond, because the prevailing rate out there, most people can't really have a less selection if they want to get a lower, a better coupon on a bond, a better yield. So therefore, yours becomes more valuable because yours started when the interest rates were a higher environment there. Okay, higher interest rate environment. So there is always that inverse relationship on bonds. Let's go back to the Schwab.com platform here. Now, if you are interested in learning more, there is more. If you go to the Learn section, I showed you the courses. There's also Insights in Education. You can go to bonds there as well. Now, for a lot of you, you may be saying, well, this seems kind of daunting, trying to invest in individual bonds, because look, I've got to kind of evaluate the company and its credit worthiness, and I would rather just invest in a bond fund. That is certainly a possibility. There are bond mutual funds, there are bond ETFs. And if you're on the research page, I can't go into specific ETFs here, but if you're on the research page, let me just point out to you, under research, you can click on ETFs. And when you click on ETFs, there's an ETF screener. And when you go to that ETF screener, there's different categories. You can go to basic, and if you go to fund category, you'll see there's like bond fund categories, okay? And you can go there. Now, that's as far as I'm going to go with you today on that, but just realize that is an alternative to you. But just like with equity ETFs, it doesn't save you from the risk. You know, if you buy any fund, it can still go down to zero. So just be aware of that. All right. So that's it on ETFs right now. Now, maybe you go, well, look, I don't want to buy an ETF. I want to do individual bonds, but I want to talk to somebody. Well, you can do that. We have fixed income specialists here. If you go to research and click on bonds right there, bond CDs, fixed income, and you scroll down on the page, it's going to say, call a fixed income specialist. You can talk to somebody, okay? There's a phone number for you, 877-566-4021. You can do a little chat there, okay? So you can help get some guidance on bonds there. So realize that's another. I'm trying to give you choices because I'm not trying to direct exactly what you should do, but I'm trying to give you choices. Now, if you do decide you want to buy individual bonds, you can do so. So let's go back to where we were, research. You start with research, typically, probably. Go to bonds. And let's go down and let's just look at some, I'm going to look at A-rated corporate bonds. We're getting a little higher interest rate on those. There's still what we'd consider investment grade with an A rating. And what I can do is I can click on that and it's going to come up with possibilities here for you. Okay, and some of these are companies you may have heard of, and probably some companies that you may not have heard of. Here's Citigroup, Deutsche Bank, and Amazon. Okay, and that is so there's some choices for you. If you go now, let me just point out a term here on this page that you may see, and that is this, callable. What does callable mean? Callable means remember, the bond is you are loaning money to a company and they're agreeing to repay you with the interest rate. Okay, so here's a 4.5% coupon rate. Okay, so this is callable, which means Citigroup Global can buy back, can pay you back your original principal on that bond early and not have to continue paying that coupon out. Now, why would they want to do that? Well, if interest rates go down, think about what, from their perspective, do they want to keep paying you a 4.5% rate when they can issue a new bond at a 3.5% rate or something like that? The answer would be no. So that is what a callable bond is. And callable bonds typically are going to give you a higher coupon rate than a non-callable bond. Okay, but that's what that term is there when we talk about callable. But you can see more information. You can see the rate and the maturity on these. And these are roughly a year away because that's what I clicked on before. So let me get out of my little drawing tool. And you can see different bonds here, Toyota and whatnot. So there we go. Now I'm going to click on this Amazon one right here. Okay. So I'm going to click on this. Actually, I'm not going to click on this. I'm going to go, hey, what if we wanted to buy this? What do we do? Well, you click on buy. You can click on buy there. Okay. And here we go. So we get some information on this company here, on this bond, I should say. One thing it gives you is a CUSIP number. Okay, so if I ever want to let me just copy that for now. If I ever want to pull this bond up later, I can use, that's like a unique identifier on this. And it's also going to tell me like minimums I can buy. Okay, minimum $9,000. Okay, and $1,000 increments that's typical, $1,000 increments on these. Okay, and it's giving me a minimum, and it gives me the relevant info on that bond there. So if I wanted to, I can go and review that order. I can put in the parameters on that information there as well. Okay, so let me go back we're going to go back to research, and let me go back to bonds here. Now, that was an example of buying an individual corporate bond with an A rating. You can do a similar thing with treasuries if you want, okay? You can do a similar thing with treasuries if you want. But you can, another approach here is to do a treasury ladder. And to get to treasury ladder, there's different ways you can do that. One is you can click right here on this page, CD and Treasury Ladder Builder. And you can go down here as well. And so what is a treasury ladder? Well, let me doodle here a little bit more and kind of explain a treasury ladder. As we mentioned, one of the challenges with bonds is interest rates may go up or down. And you may want to, instead of buying 5 years of bonds and then just then all of a sudden get them all mature and reinvest after that time period, you may want to smooth out a little bit, and you may want to buy a few at a time. So let's talk about, like, we have now, and let's talk about 1 year from now, and let's talk about 2 years from now, and let's talk about 3 years from now. I'll make this kind of a short one here. Okay, we'll do a 3-year ladder. So this is a 3-year ladder. So what I'm going to do is I'm going to say buy a 1-year bond, something that matures in 1 year. So I'm going to buy this. So I'm going to buy a 1 year now. Buy a 1 year. I'm going to buy one that matures in 2 years, and I'm going to buy one that matures in 3 years. Okay, that's right now. And what's going to happen in 1 year? In 1 year, this guy is going to mature. So that will be out of the picture. In 1 year, this one will be expiring in 1 more year. Okay, this one will be expiring in 2 more years. And at that point, I will buy one that expires in 3 years. And so on. And then another year comes around, this one will be expiring. This one will be expiring in 1 year, and so on. So that way, I'm continually reinvesting in new bonds at the prevailing interest rate. Now, that doesn't, that may be helpful or may not be helpful depending on what the interest rate environment is. But let's go back and show you how you can actually do that and see that on this platform. So if I click on CD and Treasury Ladder, you click on that, and you can create your own ladder with however many years you want. But I'm just going to click on, say, a 5-year ladder. Let's do a 5-year. Oh, that's a CD ladder. So I'm going to click on a Treasury ladder. Notice this often gets me on this. There's CD ladders, there's Treasury ladders. I'm going to click on a Treasury ladder. I'll do a 5-year Treasury ladder. So, average annual percentage yield is 4.6%. So I'm going to click on that, and I'm going to say I'm going to invest $20,000 here. Okay, so we have $20,000 to invest, and I'm going to choose. I got to choose an account, and then I'm going to press continue here to choose my investments. Okay, so now I have a ladder. Now I have these different rungs. Remember, this first go around, I'm going to be buying a 1 year, a 2 year, a 3 year, 4 year, and 5 year. And in another year, I will then buy a 5 year out at that point, because our 1 year will have expired at that point, or it matured at that point. Okay, so let me get out of here, and let me go, and I'm going to just I'm going to click on, and I have different choices here on this. Let me just click on this. And you can see the coupon payment here. And so it's a semi-annual, there's my maturity. And now another thing I should probably mention is is the price. Okay. Remember this, we are buying these from somebody else. These may be cheaper or more than par value. Par is going to be 100. Okay. Par is going to be 100. So this would be purchased at what we call a discount to par. It's cheaper. And the reason it would be cheaper is it may be cheaper because the interest rate isn't as good as what the prevailing rate would be there. Okay. So, and similarly, here's one that's actually at a slight premium. Rates, you're paying a little bit more probably because rates here on this one are a little bit higher than they're a little bit higher than they are prevailing right now. So that's why you may be at a discount or a premium to par on that. Okay, let me click on this and I'm going to click there. Okay, and it populated my first rung on my ladder. Now, I'll be getting a small little interest payment right here. It's kind of hard to see in this light blue. And then here's the repayment of the full shebang in about a year. Okay, I'm going to go to the next rung here, and I'm going to do a similar thing. Okay, now we've populated 2 rungs, and you can see my interest payments every 6 months. Okay, and then we're going to go to rung 3. I'm just going to go here, click on that, next rung, and we'll finish building out our ladder here. And rung 5. There we go. Okay. So here is what my ladder looks like. This is a 5-year ladder. Doesn't need to be 5 years or whatever, but you can see every kind of April, June, July time period, I'm getting that semi-annual coupon right there. Every kind of November, December time period, I'm getting, you can see it it's kind of hard to see right there, but there's a little interest payment right there and right there that we're getting paid. And there you go. Each year, one of these pays back the principal on that. And this is kind of hard to see, but you'll see that the interest payments actually get a little bit lower over time. Why? Because this doesn't assume that I'm rolling out. I'm buying new bonds each time into the future. But if I keep buying new bonds into the future, this would presumably be higher there. Okay? So that's how you can do a bond ladder. You can do bond ladders. This is one, a treasury bond ladder, but you can also do a corporate bond ladder. So here's the details on this. Spending $20,000 about, and there you go. Now, and I can go and I can trade that or export that if I want to. Okay. And so by doing this, what I'm doing is, regardless of what rates are doing, I'm smoothing them out. This is maybe a little bit analogous to dollar cost averaging with stocks. With a long-term investment strategy with stocks, you may buy stocks over different periods, maybe just kind of periodically buy stocks. The stock goes up or down or whatever. And this would be if you're not trying to time more precisely the market. And it may benefit you, it may not so much. I mean, an alternative to doing this is I could just put all my money in a 5-year ladder here, 5-year, and not deal with it each year. But then I'm taking that interest rate risk there. Now, in the chat, Sim Architect said, this is great if you're living from your investment. Yeah, a lot of people, there's a lot of investors out there, particularly more retired investors who are dependent upon income. And this is one way, in addition to the things I talked about before, of diversification, lowering risk in a portfolio, and in addition to that, it provides you income over time. And so that's a very popular approach to investing. Now, let me show you. So there's that, and then you can trade those if you wanted to trade those. Now, if you want more information on bonds, let me show you another place to get more information on bonds. I'm going to go to research. I'm going to click on bonds, and I'm going to scroll down, and you can get, we have a knowledge center right here that you can look at. Understanding fixed income, types of fixed income, etc. Will your retirement income last? But additionally, if you go to learn and go to market commentary, when you go here, let me just mention some things. Municipal bond outlook 2025. So this is kind of a forecast for next year. This just came December 5th. When was today? Today's the 5th. So this came out earlier today. You can read that. You click on it. It gives you a whole article on municipal bonds. You want corporate bond outlook? Hot off the press, folks. 2025 corporate bond outlook. That came out today, right there. General overall fixed income outlook. So what are the things that you'd be considering? Well, probably partially, what are interest rates going to be doing here over the next year? That may impact what percentage of your portfolio are going into bonds or bond funds or something like that, fixed income of that sort there. Okay? So make sure you follow up, read those. And let me just double check. James has been doing a great job helping me out with answering those other questions, but let me just make sure if there's other things here that it would be helpful for me to get to that he was not able to get to here. I think you got it, James. Good job. Awesome. Okay. So anyway, that's your preview of using the Schwab.com platform for bonds here. Remember, in addition to the resources I have here, we have webcasts throughout the day. Make sure you subscribe to the Trader Talks channel on Schwab Coaching on YouTube. If you're watching right now, look at that video, look in the bottom right portion of that video and click on subscribe. If you haven't already, if you already have, then you don't need to click on it again. Also, this is the last session of the day, but we thank you for joining us, and thanks James, and everybody. Have a wonderful rest of the day, and we will see you next time. Bye-bye, everybody.